Okay, let me show you HBOS, and I want to show you a classic example of some of the lessons that we've learnt being put into action. Now you look at a chart like this and you think to yourself, heck, that's a mess. Let's say we're at this point, which was just towards the end of August. I'm just going to later on scroll it forward to capture the whole of September. And you say, okay, downtrend, and you draw it rough and ready. Remember, I don't draw these with precision. I say, okay, that's one peak, that's another peak. Okay, we don't quite go through the peak, but anyway, that'll do. And you draw the downtrend line. You say, yeah, the stock's moving lower. I certainly don't want to be bullish on it. You look at this and you say, interesting. It's oversold, starting to rise a bit, but I'm not getting any price confirmation, so I'm not going to look at the MACD. Remember, that's some of the things we've learned. And we look at this and we say, well, you know what? Even before I think about getting in, first of all, you've got this price resistance here. So the price is going to have to break that. More importantly, you've got this downtrend, so the price is definitely going to have to break this downtrend. You're only going to look to buy at 690, and that's if you see this being the MACD being confirmed, but you're probably looking only to buy a breakthrough at 690 with some degree of strength. And when you know you're wrong, well, if it drops to 680, or maybe 675, you know you're definitely wrong. And you say to yourself, well, 680, 690, that's a 10 pence drop, so the price better, heck, move to 710 at least to compensate me. Can it likely go to 710? Yeah, not bad. We've got some reasonable resistance. You might think, okay, if it goes to 690, I'm in, and I'll look to target 710. So what happens? You wait, and the next day you get the price moving in, nothing much happening. We move forward another day. Whoa, we've got a bit of a break. It's gone to 690. It's broken this downtrend here. It's broken this. It's had one of the highest price moves for quite a while. But we look at the MACD rising and we say, it's done that before. It's peaked its head up before. Not too impressed. And then the next day it just moves lower. So you might say, well, I'm going to wait another day. And I'll get in maybe half a position at 690 around there. But the rest, if it breaks that day's high, which in this instance was 695.5. So you get in for the rest half of the position at 695.5. Okay, what happens? It indeed does that. You're in for the full amount now. And you're up to 700 pence, so you're up a bit. You made a bit of money. See the MACD nicely confirming it. You see this rising as well, and you think, okay, I'm going to stay in. It's all looking a little bit not too bad. Plus, by the way, did I mention? Narrow Bollinger Bands usually suggest a degree of lower volatility has occurred over a period, which is what's happened up to here. That's why the Bollinger Bands have narrowed, and therefore, subsequently, we're likely to get some degree of explosive moves, being constrained somewhat by the MACD, by the Bollinger Band in red, but we're going to get some kind of explosive volatile move. Is that confirmed? Yeah, the next day, and you can see the Bollinger Band trying to constrain it, but the MACD showing what the price is doing, confirming it, and it's moving higher and higher. So we're not too badly off. Then what happens? We get another day where we're getting that volatility that we were promised by the constrained Bollinger Bands after this narrow movements here. We're getting the breakout in price. We had our stop loss, which wasn't triggered. We'd probably move it higher, maybe to a 2-day low, maybe to around 698.5 now. So what's going to happen? We're definitely going to be in profit in this trade. Isn't that great news? Then we go up, showing a degree of weakness, but the MACD is still moving somewhat, and we're above our initial price target of 710 anyway, which isn't too bad. Definitely above that, and we're not breaking below a 2-day low. It's still starting to look, well, a little bit edgy on the price, but the MACD is still up there. So we might say, okay, look, 710, definitely, if the price moves below that, you're getting out of there. Bang. What happens? Never needed to. It just shot up to 750, moved down a bit. You've got a price gap, which might make you a bit worried because gaps tend to get filled by the market. They tend to move lower, back down to 720. I might want to take a little bit out, maybe quarter the size of the position because of the gap. Even though the MACD is going so strong, especially if the price moves below that low point of the day, which in this case was 735.5, you might take half your position off or a quarter of your position if it drops below 735.5, depending on how risk loving or averse to art? Well, guess what? It never did drop below that point. In fact, the next day it started going higher. Fine. And yet again, not a problem. You're riding it higher and higher, and you've probably put a new stop at this level. Now, a low of 737. Why at that level? Well, because it's a 2-day low. So why not at that level? Now, first warning sign. The price fails to make a new high, and it's had an inside day. That could be bearish. The MACD is certainly overbought. And this little baby, stochastic here, which can be premature, is giving us a negative diversion. In other words, it's made a lower high. That's one high, that's another high. But the price has made a higher high. An inside day, remember, it's one of the patterns we had on the charting CD-ROM. That might make us a bit worried, and we might say, I want to get out of half or a quarter of my position at 747.5, which is down here, if the price drops below that the next day at any point. Ooh, it's close. It hasn't yet, but it's certainly broken that low. And this classic little pattern suggests another degree of bearishness. This is flattening out. This is still moving lower. Now, at this point, depending on how risk-averse or loving you are, you might close the whole position, half of it if it drops below this low, which is 747.5, or all of it below that position. You see what I mean? You can edge in and out depending on your level of risk aversion. And as you can see, the market does indeed drop below that. You're now at this level, although it did spike up a bit. Many people will have exited almost all their position. One or two people may have kept a quarter of their position open nevertheless, leaving the final quarter for a stop loss here or even a stop loss there, just in case the price starts to move a bit higher. And that's their prerogative. What happens? Well, it doesn't. Sort of doesn't. You might have had a quarter position in. You might have had a whole position, depending on your level of risk aversion, as I say. If you were willing to take that risk of a fall, then you would have been still in. If you weren't, and I'd probably have got rid of half my position at least at something like that point, well, fine. If you weren't at that point, it's there, and the price is broken through, and you count your blessings either way. For those who are willing to hold on and take the risk, well, they got up even higher. My point is, let's just forget these points here for a second. My point is how we handle this whole trade moving up here. The breakout, the downtrend line, the Bollinger Bands, the MACD, how we weren't even believing, just because it had risen and broken out there, well, we'd seen that before, so we wanted even more confirmation. And yet, we got a whopping great profit out of it, despite not getting in right at the start, not getting in right at the top. It's to show you a realistic type of example of how things happen in the real world when we're trading this, applying some of the principles we've learned with real trades. So I hope you found that useful, and next month we're going to have a few more trades.